Okay, we're going to start talking about exercise 210 and discuss equities. Let me get this turned over here where you can see me. I got my little piece of my office here in a video. So some of these I'm actually going to do from my office, and I'm just going to kind of talk over your solutions with you. And so I want to give you an overview, a general idea. You'll see in the chapters where they start out with a balance sheet and they go to an income statement, and then they go to a statement of changes in owner's equity. So these are all exhibits in chapter 2, and you'll go to that and you'll see that there is a section in the statement of owner's equity for paid-in capital, and then there's a section for retained earnings. So I encourage you to stop, pause the video, and go look at that exhibit that's in chapter 2 that is that financial statement, the changes in stockholders' equity. And just kind of take a look at that real quick, and you'll see that they've separated equity up into two major sources of equity, which number one is paid-in capital and the other two is retained earnings. So what they've done in this problem is they've taken the accounting equation that is assets equals liabilities plus equity, and they have expanded it. So it's an expanded version of the accounting equation. So let's do this. Let's flip back over here to the slides, and let me see if I can get this to load. Yeah, firm A here. So let's just talk about this solution a little bit. I'm going to have my cursor on this. Let me see here, we have assets and we have liabilities, and then we have paid-in capital where equity is supposed to be. But what they've done is they split equity between paid-in capital and these retained earnings. But retained earnings is an actual equation within an equation kind of thing. And so they want you to understand that you start out with a certain amount in retained earnings, and then net income is what raises retained earnings typically. If it's a net loss, it'll decrease it. But then also dividends that you pay out to any stockholders for the company are going to be deducted from retained earnings to come up with an ending retained earnings. And remember that this ending retained earnings right here is then added to paid-in capital. It's added to liabilities, and that's the same amount that's going to be in assets. So when we do in chapter 4 all of these journal entries that you'll wind up doing, you have to keep a sense of we're always doing journal entries in order to balance our balance sheet. And our balance sheet is then balanced with those temporary accounts, if you will, that wash between revenues and expenses that then become net income, which then have an effect on equity. So let's look at this real quick. We have a couple of missing amounts in this equation here for firm A, and you'll see that we don't know what ending retained earnings is, and we don't know what assets are here. Okay, so what we have to do first is figure out what is ending retained earnings, so we can then add that to the 110 and the 160 to get assets. So we figure out here, of course, by adding the beginning retained earnings and the net income and subtracting out dividends, we find out that the ending retained earnings is 112,000. And then if you add the 110 and the 160 to it, you get the amount that is the assets, which is 482. And then you come up with those two that are question marks there. So that's kind of just kind of talking you through firm A. So we can then go to firm B, and we can see that we're missing some other amounts. Here we're missing the dividend amount, and then we're also missing the liability amount. Now you can go ahead and get liabilities, guys, because you already know what ending retained earnings is. So if you take ending retained earnings here and you add it to paid-in capital, and then you take that number and subtract it from assets, you're going to get liabilities. So I'm going to have a liability amount of 380. And how do we find dividends? Well, we can back into dividends. We can add these two and subtract this, ending retained earnings, to come up with what our dividends were. And we can see that we had dividends declared and paid. Now, these are dividends that are paid in that particular accounting period between beginning and ending retained earnings. That's the amount then was $96,000 for firm B. And then we'll look real quick at firm C. And this is unique because you're actually missing two components that will get you to a number within that smaller equation for retained earnings. So what you have to do here is your first thing you would have to do is find out what ending retained earnings is, and you can do that by taking assets and subtracting out liability and paid in capital, and that'll give you a ending retained earnings of $70,000. And then you can then back into the beginning retained earnings, and you should do this now with a calculator while I'm talking about it or right after I talk about it. Please sit down and figure this out on your own. And then you're going to come up with $52,000 for the beginning retained earnings. So in other words, I want you, if you would, remember, I'm going to reinforce this as I go along. I have this and I'm talking about this. Work these problems first. Then read the problem thoroughly. Try to start the problem, and if you can't, then watch the video. But even when you finish the problem, watch the video anyway, because I give you an overview of what the author is trying to test you on, and ultimately you'll be tested on these particular problems later. But we're going to go to the next problem, which is 212 here. This is, guys, remember, just an inverted, you had a retained earnings calculation that was kind of horizontal on exercise 2-2.10, but you have 2.12, and what they've done is they've made it a horizontal exercise. And understand this, and I want to flip to me for just a second, guys. Accounting authors just love to take a problem that's relatively easy and simple, right? And they give you basically a problem that you have to back into. So their way of getting you to really know it is to force you to think a little bit outside the box and sort of be able to back into a number that you ordinarily would just very straightforwardly add and subtract to get. So in this particular slide, they are giving you the ending retained earnings and asking you for the beginning. So you would remember the way you work this problem, because you may see this on a test, is that you would want to take the ending retained earnings and then you would add the dividends, because you would ordinarily subtract that, right? And then you would subtract the net income, which you would add. And then that would give you the beginning retained earnings amount. So you'll want to practice this, guys, in the problem in Connect algorithmically, so that you always get a different set of numbers, so you know how to work this problem. It's not a hard one. It's a very simple concept, but it's just something you got to review. You probably didn't get this completely in principles. But remember that this problem is all about really the statement of owner's equity and understanding the two different sources of equity. We always have that amount that has been invested into the business, but then we always have those amounts that we earn from operating our business.